Are you getting close to retirement and starting to worry whether your savings will last? Or maybe you've already retired and are unsure whether your current investment strategy will support your lifestyle for the long run. If so, you're in the right place. Many people assume that the same investments they used while working will continue to work during retirement. But retirement is a new chapter and it requires a new approach. Let's dive in. When you're working, your main financial goal is to grow your money. You invest in your 401k, 403b, or other workplace retirement accounts, and you're often limited to a few mutual fund options. As long as you're picking low-cost funds that focus on equities, this approach works fine during the accumulation phase. Your salary covers your living expenses, so your investments can ride out the ups and downs of the market without causing stress. But everything changes when you retire. You're no longer getting a paycheck. Now your investments become your paycheck. And that requires a shift in thinking. You need a strategy that balances continued growth with steady income. If you stick with a strategy designed only for growth, you may find yourself in trouble during market downturns or periods of high inflation. The risk isn't just short-term losses, it's running out of money too soon. One of the biggest mistakes retirees make is assuming the market will always go up and provide what they need. Historically, the stock market has returned around 10% per year on average, but those returns are not consistent. Some years are great, others are negative, and very few match the average exactly. This matters a lot in retirement because you're no longer just watching your account balance. You're withdrawing from it. This brings us to a critical concept called sequence of returns risk. This is the idea that the order in which you experience investment gains and losses can have a big impact once you start withdrawing money. If the market takes a dip early in your retirement and you're pulling money out during that time, you're locking in those losses. Your portfolio has less time to recover, and you might need to withdraw a larger percentage just to meet your needs. This increases the risk that your money runs out faster than you expected. Retirement brings its own set of challenges, and unfortunately, many people go into it with outdated strategies. One major issue is that retirees often struggle to balance the need for income today with the need to protect against inflation in the future. If too much of your portfolio is in fixed income sources that don't grow, you might find your purchasing power shrinking year by year. Another problem is lack of diversification. Many retirees rely too heavily on bond funds or dividend-paying stocks because they seem like safe choices. But putting too much faith in just one or two types of investments can leave you vulnerable to market shifts. For example, when interest rates rise quickly, bond values can fall, and high dividend stocks may not always provide the stability you expect. Modern retirees also face longer lifespans, more market uncertainty, and rising healthcare costs. These factors make it clear that retirement strategies from 30 years ago may not work well today. Plus, emotional decision-making can lead people to chase high-yield investments without fully understanding the risks, or they may become overly cautious and miss out on the growth needed to keep up with inflation. A smart way to approach retirement investing is to use the bucket strategy. This means dividing your savings into separate buckets based on when you expect to need the money. Each bucket has its own investment approach, depending on the time horizon. This helps manage risk, provide steady income, and give you peace of mind even when markets are shaky. The first bucket is for money you'll need in the next 3 to 5 years. This is your short-term bucket and should be focused on safety and liquidity. Instead of chasing returns, the goal here is to ensure that the cash you need is always available, regardless of market performance. This might include high-yield savings accounts, money market funds, or short-term certificates of deposit. You can also build a ladder of short-term treasuries, or CDs, where each investment matures at a different time, giving you consistent access to funds as needed. Some retirees also use fixed annuities in this bucket. These are contracts with insurance companies that pay a guaranteed interest rate over a certain period, usually with no fees, but some restrictions on withdrawals. Multi-year guaranteed annuities, or MYGRAs, are a good example and often pay higher rates than CDs, Another option is income annuities, which can turn a lump sum into a reliable stream of monthly income. These can be helpful in creating stress-free cash flow, especially if you're worried about outliving your money. The second bucket is for the money you'll need in years 5 through 10 of retirement. This money doesn't need to be as accessible right away, so you can take on slightly more risk here. The goal is still income and stability, but you can introduce more growth elements since you won't need the funds immediately. On this bucket, you can consider a balanced mix of equities and fixed income. A 60-40 or 70-30 split between stocks and bonds can work well. Low-cost index funds, or exchange-traded funds, or ETFs, provide broad market exposure while keeping fees low. ETFs are especially helpful because they offer flexibility, tax efficiency, and easy rebalancing. You can also look at income-producing investments like covered call funds. These are funds that generate income by selling options on stocks they already own. They may not see the same gains in a strong market, but they offer higher monthly income and reduced volatility. Publicly traded real estate investment trusts, or REITs, can also play a role. These provide exposure to income-producing properties without the headaches of being a landlord. They tend to offer regular income and some protection against inflation. Diversifying this bucket with individual bonds, laddered CDs, and additional annuities can add further stability. The idea is to let this money grow for a few more years while still being ready to support you if markets don't behave the way you hope. For many years, the standard advice was to keep 60% of your money in stocks and 40% in bonds. This was supposed to give a good balance of growth and safety. But today's retirees face different challenges than those in the past. Market swings can be larger, interest rates are more unpredictable, and lifespans are longer. The old rules don't offer the same level of comfort they once did. A more flexible, thoughtful approach is to design a portfolio that meets your actual retirement needs. That includes building in reliable income, protecting against inflation, and allowing for enough growth to keep your money working. This might mean moving beyond simple bonds and stocks to include annuities, REITs, and income-focused funds. It's not about making things complicated, it's about creating a plan that actually fits your life. Retirement should be a time of freedom, not fear. But that freedom only comes when you've planned well. Relying solely on market growth or sticking with outdated strategies can leave you exposed when you can least afford it. By shifting your mindset from pure growth to a combination of growth and income, and by organizing your portfolio into buckets, you can create a retirement plan that's designed to last. Whether you're just starting to plan or already enjoying retirement, it's not too late to adjust your strategy. Focus on protecting your short-term needs, growing your medium-term funds, and making sure your long-term money can keep up with inflation and lifestyle costs. Thanks for watching, and I'll see you in the next video.